Welcome to Global Tax Talks, Tax in 60 Seconds. I'm Will Morris. As I mentioned in last week's episode, I'm filming this in Kenya at our Africa Tax Policy and Business Symposium, so I wanted to devote this episode to tax policy in African countries as reflected in the comments of the business and government people attending. On the two-pillar project, there was much talk about Pillar 2's complexity and the very limited benefits for most African countries. The G7 side-by-side agreement is a distant issue here, but there was a real sense of dread from businesses and governments with the growing realization of the hideous complexity of Pillar 2 reporting. And also, perhaps a little late, an increasing recognition of the impact of the P2 rules on the widespread use of non-P2 compliant incentives, i.e. non-refundable ones, used by many African countries such as Special Economic Zones or SEZs or Zs. There was talk, but not huge confidence, that the substance-based income exclusion might be part of the answer, and finally concern about other countries' IIRs and UTPRs negating and taxing African incentives and whether QDMTTs might be the answer. Of Amount A, there was almost no mention nor much talk of DSTs as such, although Kenya's significant economics presence test, with a newly proposed extension to streaming, cloud computing, hosting and data storage, etc., looks quite like a DST. It's dressed up as an income tax with 10% of revenue treated as taxable income and then taxed at 30%. Instead, many countries on the continent have been moving towards taxing digital services under VATs, although Kenya does both. And still on P1, there was slightly more enthusiasm expressed for Amount B, but little confidence that developed countries would ever agree to a high enough rate to be meaningful. On indirect tax, revenue authorities are trying to move forward rapidly with digitization to allow e-invoicing / real-time reporting. Interestingly, digitization is also discussed in terms of bringing the informal economy out into the open, not so much, at least at the moment, to tax more, but to collect data and to get the so-called nano businesses, 97% of the total in Nigeria, into the system. On a really positive note, many governments talked about tax reform efforts, but none more implicitly than Nigeria. The thoughtfulness with which tax reform has been pursued, stakeholders brought along, the vast reduction in the number of complexity of the tax laws achieved, while ensuring that tax goes digital and promotes rather than impedes growth, is truly remarkable. But the thing which came through most clearly, whether from East, West or Southern Africa, was the desire, hunger almost, for growth-friendly tax policies. While incentives and SEZs have a role in this, there was more focus on the fragmented nature of the continent economically, particularly the difficulties of doing business between countries with tax and tariff barriers, but also the increasing tendency of countries to copy tax ideas, sometimes complex ones, from other countries, but always with variations. So harmonized templates for legislation could provide considerable relief. And finally, there was a plea for governments to understand the economic impact of taxes. One leader explained how a 1% increase in excise taxes led to a 7% fall in sales, to the detriment of both business and government. To close, I'm really struck by how many countries here and businesses are taking tax policy increasingly seriously and with a distinctively African focus. I'll be doing a series of GTT interviews on all this, so please follow those when they're out, and come back next week so that you stay global tax ready.